Hey everybody, welcome to our investor webinar for the Athens offering in Athens, Georgia. My name is Ryan Gibson. We're going to go ahead and get started. Thank you for joining us. Tonight we're going to be talking about how Spartan is expanding its footprint in Georgia by adding its 19th property to the state. And this is a ready-to-open facility in Athens, Georgia. Specifically, it's actually already open. So the facility is about 10 minutes from University of Georgia, which has about 44,000 students. And it provides a lot of storage. It provides much needed storage to a very vibrant college town where the growth rate is 10 times the national average. And more than 9,000 houses have been built in this area with 2,000 more under construction. So I think, getting right to the point here, this is a property that we're buying well below what it would cost to build it. So it provides investors with built-in equity and steady cash flow as we increase occupancy. There won't be cash flow for the first few years because of the nature of leasing it up. And as you can see by the pictures, this is a brand new property, and there's over 700,000 square feet of unmet demand within 15 minutes. So there's only 2 competitors within 5 minutes, and there's no new self-storage facilities being built in the pipeline. So that's what we're talking about tonight. We're talking about being able to buy into something that's lower than what you would pay to build it otherwise. To include the land, it's about $87 a foot all in, which is really a great basis. And it's right by the University of Georgia, and Athens is just a really growing market. It's basically turning into more of a suburb of Atlanta. But with that, we'll go ahead and just get into some of the specifics about how to invest. If you're want to know what the next step is, you go to our investor dashboard and you create an account. And the way that you do that is you go to Spartan-investors.com. That's our website on the screen. And on the top right-hand side of our website, you can click on that. Takes you into the offering deal room, and then you can access the SIG Athena Drive investment, which is what this is called. And then you get everything you need in there, like the offering documents, and then you'll see a button here where you can start your investment and subscribe. If at any time you don't have an invite to the dashboard, you can talk to either Ted or Jack or myself. You can email me at ryan@spartan-investors.com, and we can invite you to the dashboard so you get a login. And if we discuss something tonight and you're wondering where you can find projections, financials, deal documents, PPM, this is where everything is stored and where all your investor updates are posted on a monthly basis. In a shortcut here, there's a QR code on the screen that'll also take you to the investor dashboard where you can create an account and log in. So if you just joined us, welcome. We're talking about the Athens Drive, or the Athens, Georgia investment property. And but before we get into the deep details of the deal, we got to get our legal disclaimers out of the way, which is we're not offering any tax, legal, or investment advice. Do your own due diligence and consult your legal, tax team, and tax professionals before making any investment decisions. And lastly, this is just a general overview. We specifically can't cover everything in this webinar, but we're giving you an overview of the deal. But before we get into the deal itself, I see some new faces on the webinar. And so I just wanted to address who we are and who the leadership is team and who is actually running this operation. So Scott Lewis and myself are the co-founders. Scott is our CEO. I'm the CIO. We both started the company in 2014, and we've been in business now for about 10 years. This is our leadership team that comprises our storage, construction, and operations specialists. And we're headquartered in Golden, Colorado. We have a physical office there with a satellite office here in Seattle, Washington, where I am recording this webinar. And our leadership team consists of seasoned storage professionals, well-versed in storage operations, construction, and asset management. And we're vertically integrated, meaning that we operate these facilities ourselves and do asset management, and we even built them. So we are a fully integrated shop with about 150 employees across 13 states. And we have a deep bench of storage professionals, and we're vertically integrated, as we mentioned before, handling all aspects of the operation. And we've assembled about a $600 million storage portfolio. We've been recognized by Inc. 500 and Vet 100 as over the last 4 years in a row as one of the fastest growing privately held companies. And we also made the Inside Self Storage Top 100 Operators as number 36 in the nation. And recently we were named Best Places to Work again by the Denver Business Journal. So a little bit about Spartan. We operate two companies under Spartan, Free Up Storage, which is our national brand. So if you go to one of our storage facilities, you'll see Free Up Storage on the building. That's us. That's Spartan. We only manage our own properties. And then if you see some contractors out there building a self-storage facility somewhere in the country, we've built across 10 states. If it's SCM, that's our construction company that operates separately. Now, our construction company isn't doing anything in this specific investment because we're not building it. It's already built. But we do have that capability. This is where we operate currently. You can see that in Georgia, we actually added an 18th property in here that's not listed, but this is actually our 19th facility in Georgia. And over the past decade, we've aggregated 62 facilities. We've also sold some. We've sold about 8 or 9 properties over the years across 13 states, consisting of 4 million square feet of self-storage, and we have over 30,000 units. So our focus has been growing in markets like the Pacific Northwest all the way down to the Sun Belt region, where there's population growth and favorable demographics for self-storage. And so the investment in Athens is a perfect fit for us. It's the type of market that we like to play in. So talking about our track record, we've had 16 realized investments, meaning that we've had 16 deals go full cycle, dating back to 2014. Our worst performing deal realizing a 12.1% IRR, and our best or recent one achieving as high as an 83% return. And we've never lost investor capital or had a capital call. Now let's talk about why self-storage. I always bring up this slide because I think it's an important one. Storage demand by each person has grown over the years. You've probably thought, man, I just see these self-storage facilities coming up everywhere. And that is true, and it's been able to keep up. It's in order to keep up with the surging demand that Americans have for storage. However, recently supply in America has been reduced because it's been harder to build new assets. It's been harder to get financing. It's harder to get permits, and some jurisdictions have even disallowed self-storage from being built. And you can see here, though, in the chart, back in the 90s, every American would use about 2 square feet on average. And now that per square foot average has soared to over 6 square feet per capita, meaning that back in the 90s, people use about 2 square feet per person. Now they're using over 6. So you can see that Americans are using storage more and more every day. And we chose this industry because we wanted something that was easy to maintain, easy to evict our customers that didn't pay, and easy to operate. And storage stuck out with that. We also like the fact that it's recession resistant. Over the last 40 years, it's been one of the best performing asset classes among all other major asset class types. And it's been recession resistant to downturns. Storage is doing phenomenal right now. We actually have had the most move-ins, most customer acquisition we've ever had in our portfolio just last month. And we've also been raising rents. We just raised rents on 11,000 customers out of the 30,000 customers that we have in effective June 1st, and we only lost 5% of those customers that had their rents increased. So it's a very resilient asset class. So if you've never used a self-storage, you're wondering why people use self-storage, really it's for the 4 reasons, the 4 Ds: death, displacement, downsizing, and divorce. And these are the 4 reasons that people use storage. 70% of the reasons, or 70% of our customers have one of these things. So if you're moving, you're downsizing, you're relocating, you have a job change, you hit the road, whatever it might be, that's why people use self-storage. I always like to tell the story of when I had my daughter, my wife and I, we used self-storage because we moved to a new house and we had to stage our old house and sell it. And then likewise, when we bought our new house, we renovated it and we used self-storage during the renovation. So self-storage happens regardless of what's going on in the economy, good or bad, because of life events, which is what all of these things are. The other 30% of our customers are business uses. So Amazon, Etsy businesses, sheet metal contractors, landscaping companies, real estate, furniture, staging companies, especially when you have a lot of new houses coming around a property. We see a lot of staging companies. We like to operate around military bases, typically, where deployments and transient natures of soldiers use self-storage a lot. Likewise, colleges and universities use self-storage. Students use self-storage a lot, which is why we like this Athens deal so much, because there's 44,000 students always coming and going at University of Georgia. We actually have 4 universities in that market, so really nice base of customers. So I always like to talk about our exit strategy. What is our plan for Athens? What are we going to do when we lease up this property and stabilize it? Well, we've been growing a portfolio across the nation, and we buy mom and pops. So if you look at the medium-sized fish there in the middle, that's like Spartan. We go and we buy these little mom and pop properties like we're buying in Athens. And we've aggregated that to about a $600 million portfolio. And eventually we're going to sell these off to REITs or refinance the property or sell it to a local operator. But, you know, our value add is going to be getting this property fully stabilized and then selling it. So here's why I love the Athens deal. At the end of the day, you can talk about how great the market is or how much unmet demand there is or being around a college or a university. But real estate is all about making money when you buy. So we've secured this 101,000 square foot property for $8.5 million. And that equates to approximately $85 a foot for this building. And that is well below replacement cost, meaning that it would be cheaper to buy this than to build it. And since the property is brand new, we'll have the benefits of new construction at a discounted price. And so as a result of all this, what it means to you is that you get built-in equity from day one and strong risk-adjusted returns. So when we look at this property, we really have an opportunity to have built-in equity from day one and great returns based on the risk that we're taking. Now, what are the returns? Well, we have 2 classes of shares. So for those who invest $100,000 to $499,000, the returns are 20.1% annually. Over a 5-year hold, we project holding this asset for 5 years, then selling it, which is a double your money or a 2.01 multiplier. That means that if you put in $100,000, you'd get your $100,000 back plus $100,000 on top of that. That's what the 2.01 multiple is, and then a 15.1% IRR. Now, if you put in $500,000 or more, or get your friends together and do $500,000 together, you can get a higher class share, which is Class B returns, 25% annually over a 5-year hold versus the 20%. So 5% better per year and a 2.3% x equity multiple over the hold period. So you'd get your $500,000 back plus $500,000 and change back after the 5 years. So an excellent risk-adjusted return for an asset like this. So talking about the market, so you can see on the top there, our Athens property is to the east of University of Georgia, about 10 minutes away. And the market is thriving. The city's economy is anchored by University of Georgia, which had an $8.1 billion economic impact on the state in 2023, and it enrolls over 40,000 students. So with this vibrant talent pool and business-friendly policies, incentives, the city is becoming a magnet for companies looking to establish or expand their presence in the region. And in 2023, Meisner, a leading medical product manufacturer, announced plans for a new $250 million facility within a mile of our site. And what that means is it's going to bring in 1,800 jobs to the area over the next 4 years. And in addition, the recently opened $6 million Athena Studios is directly across from our property. That creates about 500 new jobs. So we're talking 2,300 jobs coming in right next to our property, which, as those in real estate know, for every main job, you create 6, right? You have people who work at Starbucks and do the cleaning and the whatever it might be, and that means more people move to the area. More people moving to the area means more use of storage. So we love the influx of jobs that is fueling this economy, driving up salaries and driving people to the area. Specifically, the income growth rate within 1 mile of our property is 5.79% annually, which is more than double the national average. And that points to the potential for having strong rental rates of our property. So our property is, the market's getting about $15 rental rates. And so we see that going maintaining or increasing as we lease up the property. Okay, so let's talk about all that population growth that I just talked about. Let's talk about exactly where it's coming. So if you look at this map, I've given a 5-mile radius, 5-mile ring around our property, and all the little drop pins, the gold drop pins, are those 2,000 houses I mentioned that are coming into the market. So the solid economic growth in Athens is drawing residents to the area in record rates, and the population growth within 1 mile of our site is really impressive. It's 3.45% annually, which is more than 10 times the national population average. And Athens is projected to grow by 30,000 to 40,000 people over the next decade. I mean, that is massive. And between 2018 and 2023, there's been more than 9,000 houses that were delivered across the 60 different developments here. And the majority all within this 5 miles ring of our site. So if you think about Athens, the west side of Athens is super established. The east side is where all the population boom is happening. We are on the east side, and we are the we're the newest facility, and we're the only facility in the pipeline in the immediate area. So, we see that alongside the 44,000 students that go to University of Georgia, Athens is going to be a great residence for people who are seeking a new home, new job, and it's consistently ranked as one of the nation's best cities to retire to as well. And in addition, workers and families are increasingly migrating to Athens for larger hubs like from larger hubs like Atlanta to get more affordable quality of life and also have great employment prospects. So we love the market. Now let's talk about the unmet demand. So we studied the market, and the way we do this is we look at how much population is in the area and how much that population uses self-storage. And we come up with a multiplier that provides us with how much demand for storage there is. And so if you see in the blue outline, we've calculated that there's 700,000 square feet, over 700,000 square feet of unmet demand for storage, meaning that this 100,000 square feet that we've delivered is really going to fill up fast. And so while the west side of Athens is well populated, well supplied with storage, the east side is a completely different story, where the area is undergoing rapid residential and commercial growth, and local storage providers have been unable to keep up with the pace of demand. All of our competition on the east side is 90% plus occupancy. So we have 700,000 square feet of storage deficit within 15 minutes of our site. That's the blue on the screen. And our competing self-storage facilities are few and far between. There's only 2 within 5 miles of our site. And there's no developments of new self-storage in the pipeline. And as a result, we're poised to kind of fill a significant gap in the market by addressing the growing appetite for storage, fueled by students, businesses, and residents. So let's talk about economies of scale. We're already in Georgia, right? So you can see all the white drop pins on the screen. Those are where all of our current properties are. We know this market. We know it well. And it's our second largest footprint in the United States. And with this being our 19th property in the state, we know the market well. We're familiar with the pricing strategy. And we've already have a robust operations, asset management, business development, marketing functions in place. And we have free up storage Murrayville to the west and our 4 Macon properties to the south. And so we can leverage our expertise in that way. And we're able to get better efficiencies and leading to higher and better margins for our investors. So we know this market well. And, I think that's a really important thing before deciding to invest is, does the operator have experience with the market? We do. Now let's talk about the facility itself. So you can see that it was built in 2024. It has about 600 climate and 600 non-climate controlled units. So what does that mean? That means that customers have a great choice. When they show up, they can store their belongings in heated and cooled air-conditioned buildings, or they can have the convenience of being able to just drive right up to the door, unload and unload their stuff, and be on their way. Now, you can see in the picture that there's some additional pads in the back. And so those will all be delivered in the coming months here to make up this 100,000 square foot property. But right away, this facility is already open. So we're already open, already leasing units. I believe the operator has achieved something like 10% occupancy in the very short time that they've been open, and they've been leasing up around 27 units a month, something like that. And so we've actually decided strategically to partner with a REIT to manage this property. So CubeSmart is actually going to put their name on the building. And the reason why we did that is because they're the dominant presence in the market, and they're going to have one to the north and one to the south. And so we're going to be flanking the competition really, and driving leads to the site will be advantageous by using this, by using CubeSmart to manage it. So we're really excited to partner with one of the top REITs. Now, talking about the square footage, property details, it's about 1,000 units. Again, 600 are climate controlled, the rest are non-climate. And the site's about 7.25 acres. It was built this year, about 101,000 net rentable. You can see the property super clean, no deferred maintenance, brand new asphalt, brand new buildings. Really nice property. We talked about the returns earlier. Class B return, so minimum investment's 100,000. Class A returns are on the screen. We went over those earlier. Class B returns are on the screen. But let's talk about the capital stack. So we're putting a 53% down payment. So huge down payment, and we're only leveraging 47%. We're planning on getting about a 7.75% fixed rate loan with 2 years of interest only and a 5-year term. And that's the simplicity of the capital stack. And if kind of digging into the capital stack even more, again, we're raising about $5.4 million from investors. Spartan does put in its own money in the deal, and we also put the personal guarantee on the loan. So we've got a ton of skin in the game. The debt's about $4.8 million, and our total project cost on something like this is $10.2 million. And how we're spending that money is we are buying the property for $8.5 million, and then we're putting about $1.1 million just in case on reserves, and also to sustain lease-up losses as we go through the lease-up of the property. So we've left about $930,000 in lease-up losses, and the rest in just contingency backup funds. So tons of reserves for this property. And then when there's about $600,000 in closing costs, CapEx, acquisition fees, and so on. And so the financial highlights, and one thing I really wanted to highlight this is we're buying this at effectively an 11% cap rate. And the cap on cost is what I call it. And that's basically, if you look at the total project cost divided by, or the NOI that we stabilized the property at divided by the total cost of buying this property, it's 11% yield on cost. That is an amazing metric for a property like this, especially when it's already open and already built. And we're basing that on a 5.75% cap rate on the exit, and operating at an expense to gross income ratio of about 33%. That means that for every dollar that we earn in revenue, we're planning on spending 33 cents to operate. And that gives us a debt service coverage ratio of 2.41, extremely healthy. And break even in year 5, about 55% occupancy. Now you notice in year 1, 2, 3, and 4, break-even occupancy is above that 55%, but that's because of our business plan. And our business plan is to lease up the property at discounted rents, approximately 30%, and then over time, we increase those rents to bring our facility up to maximum revenue potential. And as we do that, that's going to lower your break-even occupancy. So this has got about a 55% break-even occupancy for all intents and purposes. Now, what do investors get? We do $100,000 to $499,000 Class A investment. You get a 7% preferred rate of return, a 70-30 split to an 11% annual return, then a 50-50% split thereafter. And then for $500K or more, investors get an 8 pref, 70-30 split to a 16% return, and then 50-50 thereafter. So pretty straightforward, very favorable to the investor. So here's kind of how we're going to run our business plan. So we have this empty property, or it's leased up a little bit. We want to discount the rents so that we can fill up our property, and then we do what we do best is we raise rents. We do existing customer rent increases, or ECRIs. So right now, we're going to start the rents out at about just shy of $12 a foot, so $12 per square foot annually. And then in year one, and you can see the current average, the current market's at $14 and change, right? So that's where we are. So we're going to be below market rents, 18%. And we're going to be below market rents all the way to the almost the very end of our business plan. Now, current market average is 14, but there's operators in this market that are charging closer to $17. So when we say average, we're taking all the junky properties. We're taking the rundown, mismanaged properties. And then when we look at the current market max all the way over on the right-hand side of the screen, those are the properties that are charging the most because they have the best quality. We believe that we're going to have a high-quality property because it's brand new and it's going to be professionally managed. But we're just basing things off the current market average, which is more conservative. And so in year 5, we still plan to be below the maximum market rents that are being charged today. So you could argue that we're not really planning to raise rents above where the market is today, which if you know investing and you know how some of these pro formas work, we're basically saying we're not raising the rents above where they are today, which is extremely conservative, especially since there's 3.45% population growth projected and current. There's tons of houses, tons of jobs coming into this market. The demand for storage is only going to increase, but we're not saying that the rents are going to go up anymore. And in fact, for the first 4 years, we're actually planning on those rents being below where the average of the market is today, which is including the lower quality assets among the higher quality assets. So we're essentially saying not only are we not going to go above the market max, but we're going to be below for the first 4 years. So we are very conservative on our projections on this opportunity. So here's a sensitivity analysis. I love this slide. It's probably my favorite slide in the deck because it tells you what we're planning the market rate rent growth to be. So 2.7%, and what we expect the cap rate to be at exit. So, and then and you can use a sliding scale. So if you're like, well, I don't think it's going to sell for 5.75, I think it's going to sell for a 6.25. You can just slide over to the left and you can see that your return would be 20%, 20.4% if you did that, right? If you're like, Ryan, I think you're being way too conservative on the rents, but I like your cap rate, you could slide down to the bottom and say that the market rates are going to go up 4.2%, and then you're going to be at 27% return. So this is kind of a sliding scale of different risk factors to kind of give you a good sense of where the returns are going to fall. And likewise, we do the same thing for equity multiple, providing our projections on rent growth and cap rate. Now, that's all the time that I have to talk about the property today. I'm pretty excited to present this to everybody. We've already committed over, I think, 75% of the cash for this deal because of the low basis that we're getting in the property, the discount, and the opportunity that how conservative we've been. But if you wanted to take the next steps and invest, you go to our website, Spartan-investors.com. You can create an account, create a password, you log in. Once you get into our portal, you're going to see SIG Athena Drive Athens. And that's the deal that you want. You want to click on that. That's going to take you into this deal room. And everything we talked about on the webinar can be found here. So if you scan that QR code on the screen, that'll take you to our investor dashboard. Or you can go to Spartan-investors.com and find it there. If you get totally lost, you can always email me, myself, or me, Ted, or Jack. This is where you sign up to invest. This is where you get all the offering documents, and then that button Start Investment is how you start the investment itself. So this investment is open to accredited investors only. If you've given us a accredited investor letter within the last 5 years, you don't need to do another one. And I know that many people are returning to invest. So if you've already given us a letter, you don't need to do another letter if it's been within 5 years. The investment minimums are $100,000, and the investment is filled on first come, first served, based on when your funds are received. So I have a few minutes for questions tonight. So I'm going to go ahead or today, I'm going to go ahead and open it up. But I always like to get the first few softball questions out of the way, which is people always ask about bonus depreciation. We absolutely do a cost segregation study. We give bonus depreciation to our investors and we pass that along. And that's usually 20 to 30% of your investment amount. And then now with only 60% bonus depreciation this year per the tax code, you're going to get a lot more depreciation in subsequent years as you would as compared to previous years. So you're going to still get the depreciation in the second, third, fourth, and fifth year of this investment. Okay. Another question that I'll usually get is, can I use my solo 401k or my retirement plan to invest? And the answer is absolutely, you can do that. And one thing that I probably didn't talk too much about is, why is the seller selling? Why would he sell for below replacement value and move on? Well, the seller itself, he's not an operator, and he can build this stuff really cheap because he owns a steel company. And so he needed to build and put to use some of his steel and his crews and wanted to get in and get out of this property. And our relationship with the broker and the market, we were able to secure this property and take it off before it even went to market. So we were able to get in and get a great basis and a great investment price for this asset. So we're super excited about that. When our funds due, I always say, first come, first serve. So if it fills up, it fills up. But we close in mid-July. So that's when we plan on closing on the investment. So we will own the property come mid-July, end of July, something like that. So that's when we will plan on closing on the property. Another question that I had was, you mentioned in the very beginning that this property is already up and running, but that it said it would be 2 years before any dividends are paid while you get up and running. Which is it? So the property is open and leasing units, but it's going to take a couple of years to lease the units and to get to break even occupancy. It might take a shorter period of time. It might take a little longer. But projection is that in order to get to stabilized cash flow, it's going to take a couple of years. And then we would start distributions to investors. However, you will start accruing the preferred return from the day that the property closes. So you will still be benefiting from the economic value that comes from the preferred return. Another question we had is, why wouldn't you increase rents? And I think that's in a question as it relates to staying below market. Well, there's another question that someone asked about, why would you buy in this market with headwinds and interest rates? And so we acknowledge those headwinds and interest rates. So we want to be really conservative in our future rent forecast. However, we have properties that we've built and delivered recently where we're aggressively raising rents well before we get to stabilized occupancy because we have very strong customers. So we will make rent adjustments very aggressively as the market dictates. But for backing into your investor projected return, we want to make sure that we're very conservative in that projection. I think I adequately covered why the previous owners sold the property, but they are a builder that builds and sells at the end of the day. All right. Well, that's, I believe, all the questions. So I wanted to thank everybody for coming out and attending our webinar. The next step is to invest. So if you go to our investor dashboard, spartan-investors.com, you can find our deal room. You can log in and subscribe and do the paperwork and send in the funding that way. Or just email us and we can help you out, or you can give us a call. But we look forward to having you join us, and we'll catch you on the next update. Thanks, everybody, and have a great day.